Walmart shares declined by almost 12% as food inflation costs and higher staffing costs eat into profitability. However, despite that, management has vowed that they're going to have a good fiscal year 2023. That's what we're going to cover in this video. So smash that like button and subscribe if you're new. You're watching More Money. Let's get it. What's up, guys, and welcome back to the channel where the mission here is to help at least 1,000 people achieve financial independence much sooner. And let's jump right into it. You guys can see that Walmart shares declined 11.4% on the day, and that reversed any gains that the shares had year to date. As year to date, they're now down 9.2%. And you can see here that the Wall Street Journal reported that Walmart's earnings were dented by food inflation and staffing costs. And what's interesting here is that for a long time, we suspected that retailers were absorbing these price increases as opposed to pushing 100% of them to the customers. And you can start seeing that with Walmart now with their latest quarterly release. You can see here that the country's largest retailer by revenue said sales increased in the most recent quarter, but higher product supply chain and employee costs ate into their profits. So in other words, they're absorbing price increases at the moment, as my note says there. Now, Walmart did say that its net income in April fell by 25% from a year ago as a result of what the implications of having food costs and rising costs eat into your profitability does. Now, Walmart's CEO did provide remedial actions for both issues, the rising food costs and the higher employee costs. But before we get into that, I just want to show you exactly how much of a decline that margin decline is. So you can see here that their operating margin is now down to 3.8% in the quarter, down from 5% in 2021. This is from their financial statements that they released earlier today. So you can see that that's what caused their operating income to decline by 23%, despite the net sales actually increasing by 2.3%. So they're taking it on the chin a little bit there. And you can see here, this is a snapshot of the model that I provide to the Patreons at that $5 a month tier. You can see here that on average, their operating profit margin is 4.8%. So obviously, in the first quarter, the operating profit margin of 3.8% is 100 basis points lower than the historical average, or about $1.4 billion on the quarter, or 51 cents per share. So for comparison purposes, the company earned 75 cents per share on the quarter. So you can see how material that loss of 100 basis points of operating margin can be. And you can see that the higher food costs have prompted shoppers to shift their spending away from general merchandise, which is eating into profits. So effectively, customers are going into Walmart just purchasing the staples and not getting any of the extra stuff that they would normally do when they go into Walmart. Now, here's where I'll explain what the remedial actions that the CEO said he's going to do for those two items. So you can see here that Walmart cited a host of cost increases that ate into profits during the quarter. The first cost increased item was that Walmart overstaffed their stores for a few weeks as workers came back from the COVID-19 leave faster than expected. And they have said that that issue was resolved primarily through attrition, which makes a lot of sense because at the Walmart stores, especially for someone who has worked at Walmart for a few years when I was a teenager, the door is a revolving door in terms of people who come in and people who come out. So you can easily address higher staffing issues with attrition. Or at least in my case, they alleviated higher staffing issues by just not scheduling me. But that's a story for another time. The second issue is price increases. So you can see here, price increases ate into profits as Walmart aims to keep prices lower than competitors in an inflationary environment. Now, executives have indicated that some prices would rise and that negotiations with suppliers will help balance those costs. And so you can see here, they actually did adjust their guidance going into the second quarter. So they actually believe that net sales are going to increase, not decrease, from 3% to 4%. And I think what that really does is it reflects the higher basket cost of staples that consumers are taking away from Walmart. Moving forward, they actually expect their EPS to, instead of increasing at the mid-single digits, you can see that they actually expect their EPS to decrease by about 1%. So that is what is causing the share price to decline today. And it's an indication that there could be further estimate revisions in the future if inflation begins to flame up again. And you can see here from my model for fiscal year 2023, I have built in management's outlook of a revenue increase of 4%. I've brought that gross profit margin down from their traditional 25% area to 24.25%, reflecting the higher costs that they're absorbing. And so I've gotten their operating profit margin down to 3.4%, which is actually lower than what their Q1 was, but I'd rather be a little bit conservative in this environment. And then you can see in fiscal year 2024 and beyond, I brought them right back up to their sort of like normal margin. So I expect this to sort of level out where the revenue is growing at around 3.5% and their operating profit margins are around 4.2%, which by all means is still lower than their historical profit margins of 4.8%. But if you notice, their last few years, the profit margin has actually been trending down. So that's why I'm forecasting it lower. And before I get into the EPS valuation and whether or not I'm buying the stock, guys, just remember, you can get access to all the models at just the $5 a month Patreon level. And like I always say, if you subscribe and you decide that it's not for you, no problem. Message me in the app, say it's not for you, and you get a 100% refund, absolutely guaranteed. And of course, I love the fact that the Patreon has a greater than 100% retention rate, which means that more people are upgrading than that are canceling. So it really says that people are getting a lot of value from this. Now, let's jump into the EPS. You can see here that with a terminal multiple of 20 times earnings and a terminal discount rate of 11.5%, I'm valuing the company at approximately $100 per share. That excludes the debt that they have on the balance sheet netted with the cash. So you can decide to exclude that or leave it in. It's up to you how you want to value the company. I excluded it. So of course you can see that the current share price is $131 per share. So you can see that the share price as a percentage of the valuation is 132%. So obviously not cheap enough for me to buy. You guys know that I like to buy shares that are at 50% or less of their intrinsic value. And you guys know on the share price tracker that we have for the Patreons, there are at least 7 or 8 names that are currently trading at less than 50% of their intrinsic value. And that's sort of the area that I'm dancing in right now. Now, another name that's going to be reporting very soon is Alibaba. Guys, check out this latest video that I did on Alibaba where I doubled down on the security.